Hi everybody, Marshal Strang here, top real estate agent, but also I just want to clarify before I get into this video about how you can benefit from the cost segregation and depreciating your properties, your investment properties, and how you can save as much money as possible doing this. And there's a couple of ways that I discovered from hearing. Somebody told me that you can depreciate it all up the first year, and from what I've discovered, that is incorrect, but you can get a bonus. So I'm going to break down these numbers for you. I'm not an accountant. Remember that. Most accountants honestly don't know this. So you have to ask your accountants for suggest to them ideas because they're not strategists from what I found. So not always anyways. So be sure to break these numbers down on a scenario for yourself. Get a pen ready. Take some notes. I have numbers in front of me. I'm going to be sharing them with you. This is for a client I'm currently working with that is purchasing a property for an Airbnb. So I'm going to break these numbers down for you. He purchased at $500,000, and we're going to use those numbers. So cost segregation is the acceleration of the depreciation of a property. So in California, the law is you're allowed to depreciate your property over 27 and a half years. So if you buy a property for $500,000, you have to give value to that land, approximately about $100,000 on this particular property. So that means $400,000 is what they can depreciate over 27 and a half years. That comes out to approximately $14,544 per year every year. So this person is going to be Airbnb-ing the property. So if they do have income that comes in that first year, this will offset it. But if they don't, they can use this possibly off of their other income as long as one person, so if it's a husband and wife, and the husband makes substantial income and the wife does not, or vice versa, however you like to look at it, as long as a person does 15.6 hours of real estate. So if you have 2 or 3 properties, or if you're doing the Airbnb yourself and managing it and cleaning it and things like this, you would be able to use the write-offs from this property to offset a separate income as far as another business, or perhaps just say the husband's income of his business. So going into the numbers a little better. So I want to show you what it actually costs to buy a property. So this particular situation, they use 15% down as an investment property. Typically it's 20-25, but they were able to get a loan for 15%, which is great because the less cash you have to use out of pocket, the more you can leverage and the more money you can make with your money. Borrowing money from the bank, let's say on your property. So if you have equity in your property, meaning you owe $300,000 on your property, you bought it 5 years ago, now it's worth $450,000. You can pull out $100,000. A lot of people get concerned because they say the interest rate is just too high right now. But what they're not looking at is what is the loss of not taking action and doing this. So the real estate inventory nationally is the lowest it's ever been. 4 million home shortage. It was 1 million just 2 years ago. So we're going in the opposite direction of it getting cheaper for real estate. Rates are going up, inventory is less. So if you can pull money out of your property, especially the fact that the dollar is depreciating 7 or 8%. So most people know you wouldn't want to keep $1 million in the bank. Well, why would you keep it in your property when you can borrow it like the rich people do? The wealthy, they don't use their own money. They borrow money. They have businesses and they take out loans and then they pay it back with the profits the business makes, and they're able to save money on taxes. So there's a lot of loopholes, but as individuals, especially if you're not self-employed, but when you are a homeowner and you have investment properties, this is a great way and an opportunity for you to start taking advantages of more tax advantages. So going back, this person particularly will get about $14,544 per year as a write-off. Now, they also can get the first year you buy a property, the way they see the cost segregation is off the actual property itself and not the items inside. So chandelier, dishwasher, AC, all these other items, you can do a bonus of approximately a 20% the first year on all the items inside the house, which will give you on this property an extra $80,000. No, let's see. What was the number? 90. Oh, yeah, it was $80,000, total of $94,544. This person can write off their first year. Again, consult an accountant on this, but from every accountant I've listened to, this is the way it works. I've done a research for about a week on this, looking into it. So now This person put up approximately $60,000 to buy this home. We've got closing costs mostly covered. So with that being said, with the 94K, 544 and the write-off, approximately 20 to 30%, let's just say 20% is what they save on not paying taxes on that money now. So that's about 20 grand. So really they got in for, so it was $80,000 for 15%, and then minus the write-off, it was $60K. So $60,000 they use of their own money to make over 38% on, if they would have borrowed money, this would be extra money. So you have to stop thinking about the rates being high, because this could be the new normal. They might drop, which if they do, prices will probably go up $10,000 a month, more than likely. But if this does happen, from my opinion, a lot of experts out there, it probably would happen between July and August, September of this next year, depending on the inflation rates. So if you have properties that have equity, it is better to borrow the higher rate of 10% to make 38+% on that same money, plus you have all the tax benefits. So I wish you could write off the whole thing the first year. That's really what I was looking for, guys. But there's still so many benefits to buying properties in this market with high inflation. If inflation's going up, I mean, everything's going up. So wouldn't you want to own more properties versus having one or two paid off? Click the link below, and I have the leverage video teaching more about that as well. Look forward to seeing you soon. Have a blessed day. One last final thought. Everybody's concerned about these high rates, guys. But high rates, in the last 12 months, you see nothing but investors buying. 30% of properties are bought by investors. So stop thinking like a consumer which buys products. Start thinking like an investor. So you want to buy as many homes as possible. This is the reason. If rates continue to stay high, you win, because everything goes up. Rent goes up, everything goes up. Income, everything will go up. But if they drop like everybody's hoping for, then what's going to happen? If they drop 2-3 points, once inflation gets under control, you're going to see reverse inflation. So you're going to see property values go up 10 grand a month possibly. And this is because it all depends on inflation and how long rates stay. By rates going up, they're basically taking equity out of your home. Because if rates would have stayed at 4 or 5%, what would have happened? Properties would have went up $10,000 a month, and the dollar would be pretty much worthless. So they're trying to save that from happening. So all the specialists, everybody I've been listening to, what we're all probably going to agree on is that more than likely rates will come down. And if they come down, depending on how much, you could see the reverse of just equities going up crazy to generate more cash being spent. So right now you have unemployment at 3%. They're trying to get that to go up to slow down the money being spent. So we have nothing but good signs. They keep talking about recession, but I've been hearing about this for 7 years. So it might go the opposite. They might, by keeping the rates high, and then if they do the correct thing, if they need to, by lowering them, guys, you're going to want more properties than less. I promise you this. So having more properties is always the best option because of the write-offs, as long as you have enough liquid cash to cover you at least 3 to 6 months. So I wanted to drop in and share this last tip with you guys. Have a great day.